This is HFO's Multifamily Marketwatch, presented by Pacific Exteriors Northwest, a contractor specializing in siding and exterior envelopes, delivering exceptional quality and service for over 30 years. By Aprio, combining DeLap's Pacific Northwest experience with Aprio's global resources to offer unparalleled tax, wealth management, and advisory services for real estate owners. And by Kennedy Restoration, helping residential and business owners recover from fire, water, mold, and storm damage.
Welcome back to Multifamily Marketwatch. I'm Greg Frick, partner at HFO Investment Real Estate. Today we have with us Mark Adams, Managing Director of Accruit 1031 Exchanges. Thank you, Mark, for taking the time to sit down with our audience.
Really glad to be here, Greg. Thanks.
Maybe for people that aren't familiar, what is Accruit 1031 Exchange Company?
Sure. So we're the third largest QI, qualified intermediary in the country.
Okay.
We're based out of Denver, the largest non-affiliated title company, QI in the country. We've started out in 2000, so we've been around about 26 years. Primarily, we were a personal property 1031 exchange company for a number of years.
Until back when you could do personal property.
Yeah, until 2017, you could do personal property.
Right.
And so we had really pushed into that space, developed technology around programmatic exchanges. And obviously when that went away, there was a need to pivot. And from that point forward, we've really engaged in the real estate side of things from a 1031 standpoint, utilizing some of the technology that was developed for personal property to help with kind of the forward only patented 1031 technology in the industry, actually. So
you guys are able to go national in terms of where transactions are and all that?
Yes, we do stuff all over the country. We have a workforce all over the country. So we're a national QI doing deals all over the country.
And then so like you said, a lot of them are affiliated with title companies. You guys are independent.
Correct. So we are, yes. So we're independent. So we work with, all sorts of different, title companies, real estate brokerages, et cetera. And that's really where the deals come from for us.
Okay. Does that give you flexibility? You're not tied to it for a client. Is there an advantage to not being tied to a 1031 or a exchange or a title company?
Not necessarily. I mean, I think, the business model is mostly the same no matter, which side of that you're on. So.
Okay. So now, as you brought up, 2017, the tax law changed. Personal property wasn't part of 1031s. We've talked about that on this, this show. What else has changed over like the past 2 years with 1031s?
Yeah, I think some of the biggest changes, that we've seen, just trends in the industry are, the relocation, the geographical changes of where people are exchanging from and to. So, there's been a significant change of, people selling in certain parts of the country and reinvesting into rental properties in other parts of the
markets.
Yes, in other markets. And I think those markets are probably obvious for anybody in the real estate, industry. It's Texas, it's Arizona, Florida.
Join the HFO community and get weekly multifamily intel. Click to subscribe.
Depending on the asset class, obviously, single family rentals, which is a big portion of the 1031 business, is, those markets where people are taking advantage of maybe more friendly, landlord tenant laws, but also people trying to combine their exchanges, on a more personal, use basis where maybe at some point they become a primary residence for that person as part of their life changes. The other side and the other trend that I would say maybe more on the commercial side of things is reverse exchanges. That seems to be a lot more common in my experience over the last several years as it was before. So, you have people coming in and talking about reverse exchanges up front. And I think the primary reason for that is some of the education that's been out there and some of the advantages potentially of a reverse exchange. It's not just only doing a reverse exchange when they're unable to sell their relinquished property, their sale property prior to acquiring their replacement property. There's some other advantages there. Primarily, you don't have to worry about identifying property.
Not in that time frame issue.
Yeah, and you also don't have that gap in operational, income. I guess that you can kind of keep operating two properties until you're ready to sell your relinquished property. So those are, I think, two of the major things that always have jumped out at me as I look back at the last 2 years.
Well, it's funny because when people talk about 1031s, there's a perception that it's just done with, large, ownership groups and multi-million-dollar properties. But like you brought up, a lot of it is single-family homes or single-family rentals for an exchange? I mean, when you, I don't know if you know the kind of is the percentage of, I mean, how many are under $1 million and over $1 million?
Yeah, I mean, I think from an asset class standpoint, I would say probably 60 to 65% are single family rentals,
Gotcha.
or less than, duplex or less.
Okay.
And then anything, then the rest of it's, the commercial properties, which can span from, multifamily to industrial to, you name it, land. So that's kind of the difference that goes there. But it's $1 million. I think the average size of, 1031 exchanges, nationally is around $775,000.
Okay.
A lot of people utilize 1031 exchange for, their retirement. People may not have 401ks, but they have a couple different rental properties that, are cash flowing for them. They're building equity in those. And that's how they've utilized, kind of 1031s to always be exchanging into bigger and better properties, to satisfy kind of their investment strategy.
And then I know there was time back before where kind of was on the, 1031's getting repealed or capped. You don't hear that anymore. A lot of things because of, who's in power in Washington. I mean, do you guys kind of keep your radar up on that, or do you hear anything about that coming back around?
Yeah, so that's a great question. I mean, in 2021, when the first administration, Biden administration came in, there was the concern, and I'm a member of the Federation of Exchange Accommodators, the FEA, which is the national industry organization for 1031 exchanges. We work with a law firm in Washington to lobby, the Congress people in that area. And there was a real concern in 2021 that it was going to be capped primarily or maybe even eliminated. And we go up there routinely, and we are always in front of the people on the Ways and Means Committee, the Senate Finance Committee, and just general members of Congress to educate them on the benefit of 1031. Now, most of the people that are against 1031, or think they are, it's because they're uninformed. And so what we do is we educate them of the benefits. Again, we're talking about people who are utilizing it for retirement. We're not talking about, REITs, and we're not talking, those are not the people.
But that's a perception.
That is a perception that we have to challenge and overcome. I mean, really, and we have a lot of studies out there, that's, sometimes described as this tax shelter. Well, it's not a tax shelter. It's been part of the tax code since 1921, and it's there to facilitate real estate activity. And the benefits of that real estate activity are wages from the trades that people are employed by once they improve the properties. Just the taxes that get generated, on exchanges, because as we all know, you don't reinvest fully, there's boot, and that's taxable. So the amount of revenue it generates, is very clearly more than the offset that they've tried to, argue would result in a cap. So financially, it doesn't make sense for the government to really push on it. So, we overcame that in 2021. You're right, the new administration, it didn't come up, from a standpoint of eliminating 1031. The other side of that is, there's the argument that maybe you would have immediate expensing of buildings where, and that was kind of more of a Republican talking point in terms of, hey, we could maybe do that. And that's a disaster as well. I mean, I think it happened in the 80s, a little before my time, but that resulted in buildings being, acquired and abandoned and
just looking for the yeah.
That's right, the tax write-off.
Right.
So, we don't have a concern with that right now. Obviously, things will change. We are constantly, meeting still with the people that are key to this decision as as it will evolve here over the next several months and into the next year. We are always on the lookout. We haven't heard anything concerning right now.
Okay.
But again, we are not, resting on our laurels in terms of, hey, everything's good, we're never going to have to worry about it. We're always trying to stay at the forefront of talking to those people to make sure it stays around.
And that's one of the things you brought up about the misconceptions about 1031s. I mean, what other misconceptions? Like I said, I think the big one is there's this expectation that it's big, large national companies and REITs. It's like, no, it's actually your next door neighbor, it's your mom and pop investors taking advantage of the 1031. Are there other misconceptions that you guys are having to deal with?
Well, I think just from a transaction by transaction level, misconception, always, we take phones. I'm on the calls all day talking to people, talking about exchanges. One of the biggest misconceptions for people that are, newer to it is, that they have to reinvest only their gain or their equity. So from a standpoint of, hey, I want to do an exchange, I have this gain or I have this much equity, that's all I want to put into my replacement property. I don't want to replace the debt, because one of the rules of 1031 is obviously you have to put all your proceeds in, replace the debt, or add fresh cash, out from outside.
But you can't just do your equity.
You can't just do your equity. And if you do, there's going to be tax. And I think that's, people get frustrated by that because they think, oh, 1031, it's a way to defer my gains So that's all I have to invest is my gains, and that's just not the case. So that's more for the simple, I guess, inexperienced, I should say, investor who's doing 1031s. People that are a little bit more advanced and sophisticated, the misconception, and I think some of this is due to if you plug in something on ChatGPT or Claude, and you'd be surprised, how many times we're having to overcome some of the information that is generated by that is, that you can build on property that you already own. So if I have a lot and I sell something and I want to take those proceeds and make improvements to that, can I do that? And a lot of the guidance out there says you can and you can't. There's a way to utilize a related party leasehold improvement exchange, so a very complex type of exchange in which you can do that. But if you just generally try to get information from that, it gets you to the answer that you can, but the steps that get you there are incorrect. They just don't allow that for the rules. So I think those are the two things that, on a regular enough basis, we're talking through with people to help them understand.
Are you seeing more improvement exchanges, or is it again more of a reverse exchanges have kind of come more in vogue just because I think of the economics of the market? But do you see a lot of improvement exchanges?
We have a lot of conversations about those.
Right.
So we see a fair amount of them, but one of the, aspects of the Big Beautiful Bill that was passed last year was the ability to, take advantage of bonus depreciation and immediate expensing and, through utilizing a cost segregation study. So there's a lot of thought that rather than do an improvement exchange, if I, sell a property and buy a replacement property and I have $100,000, $200,000 of taxable boot, rather than employ that or you deploy that through an improvement exchange in which the QI, not to get too technical, has to take title to the entity and use those funds during the exchange period. They just take the cash, at closing. They get some benefit from the exchange. That taxable, the proceeds then are spent in a way that they're able to offset that gain coming out of the exchange with, some cost segregation study. So it's really kind of a way to supercharge just a normal exchange without having to go through
without having the cost the complications.
The cost of doing an improvement exchange, which are improvement exchanges and reverse exchanges, because the QI is actually on title to those properties and there's a number of administrative things behind that, are more expensive.
And what about, we have a lot of people talk about, from an exchange standpoint, like Delaware statutory trust, DSTs. Do you see a kick up more of those coming as people look for ways to maybe get out, especially in multifamily, where they're looking to get out of the day-to-day active management, or this is a way to, what's your thought on those?
Yeah, I think absolutely. And I think maybe even going back to your first question about one of the changes, I think there's been a real proliferation of the DST space in the last 5 years specifically, but even in the last couple of years, as not only the traditional sponsors in that space, have stayed around and kind of developed their offerings, it's become more appealing for those people who are looking, maybe not to actively manage real estate, want to get out. It's a passive investment. There's a whole host of things that are probably on the plus side and the things to be aware of side. But with the move into this space by the wirehouses, the big brokerages, into the 721 UPREIT space, it's been huge. And so I think that to me has been one of the biggest pushes into this 1031 world, over the last several years. And I don't think it's getting smaller. In fact, the numbers bear out that
it's going the other way.
It's going the other way big time. And and the other thing I've noticed is that brokers in this world, for a while it was like, hey, if we do a 1031 exchange, I'm going to sell the representation on the sell side and the buy side. Great, I get to double end that, outstanding. But with either the lack of appetite for going and buying a traditional replacement property, they've embraced the fact that they could move that one property which may otherwise move by offering that, or at least giving it as an option to the exchangers, or the sellers of those proproperties. So,
now, do you guys get involved in 721s? Do they need a intermediary to come in on those, or can they go?
They do. So they do for the 721 UPREIT. So from just a traditional, if you just do a 721 contribution to a partnership, that's a non-taxable event. So that's not necessarily in a 1031 exchange.
Right.
But if they do a 1031 exchange into the 721 UPREIT product, which is essentially, for 2 years, it remains as DST, which DST is replacement property, so that counts. After 2 years, that DST interest converts to an operating, unit in a partnership, essentially. So
shares
now,
in a partnership.
Exactly. So typically into a REIT some type of situation. So now you have partnership shares. There's some tax advantages surrounding that are beneficial in terms of getting distributions that are actually return of basis. So again, I'm not an expert in this at all, but there's some appealing things to that aspect of doing that. Being able to defer into this DST, which then converts to the UPREIT. But once you do that, so the downside to that is that it's got to be a very particular investor, because once you exchange into that,
you're done.
The UPREIT, and it becomes a partnership interest. That's not an.
There's no more exchanging. That's what I tell people all the time.
Yeah. So that's over. Now the traditional DST, obviously, if you're in that for 5 to 7 or 10 years, whatever that is,
you can go in and out.
You can go in and out. Now that's still, you're selling real estate when that sells, that asset sells. Now you're still in the game in terms of, I want to do another exchange. Maybe I'll go back into something that I can actively manage or something different than another DST.
And do you have people asking about qualified improvement zones?
We don't have, occasionally
I get asked about it, but I always tell people, from what I've heard, it's if you're in our clients with the traditional real estate, it's probably better to look at doing a standard 1031, or maybe it's a 721 UPREIT. But
yeah, I really have not had that conversation too often. Recently, I think way back when it first came out, it was more of a conversation and question, but they're pretty unique in terms of how the rules are around those things. I mean, there's some crossover, but we just don't deal with it very often or even have that conversation very often. If people ask about it, I'm typically going to send them to somebody, an attorney who's real familiar and experienced in handling formations of those qualified opportunity funds and acquisitions.
Maybe by the time they get to you guys, they've already done their research and decided this is the better.
Hopefully,
your option's the better way to go.
Exactly.
Yes. So what is? I mean, as again, we do mostly multifamily. Have you guys seen big changes from transactions a couple years ago to where they are now in exchange? I think you did bring up the reverse exchange is much more popular now.
Yeah, it is. The market itself, from our data. So we, again, as I mentioned, have the proprietary software. So we have our own. We're the QI on a lot of things, but we also license our software. So we have data from over 31 qualified intermediaries nationwide, which is pretty unique because it's an industry that doesn't share a lot. So, consolidating that data and looking at it, if I looked at it prior to coming down here, and the market itself from year over year is down 10%, the multifamily market. So, but
in the number of transactions.
In the number of transactions, correct. And the prices, the sale price of the units is actually up 5%. So I don't really know, what that means, but it's from year to year, it's certainly gone down. A couple years ago, it was, multifamily seemed to be kind of the hot exchange property, and then it was industrial, and it really kind of cycles through the asset classes that get popular in terms of what's being exchanged, and probably a lot of it's market dependent as well, geographically. But that's kind of what I'm seeing. So
yeah, which is interesting because we've seen transaction volume ticking up a little bit the last couple of years. We talked about off camera. I'm curious. I'm wondering if we also see from I think an age and a demographic, we've got some clients that are just getting out, not doing exchange or possibly doing a contract or things like that, looking for other avenues to, they just necessarily don't want to hand it down to the heirs. So that may be some of the reason your numbers are slightly down.
Right. I think that's probably correct.
As we've seen transactions. So, and you brought up the software you guys have. I mean, what advantage does that give you? Other, the data, is there other advantages from a client standpoint coming to you?
Yeah. I mean, from a client standpoint, it's excellent because everything's automated. So that gets set. The exchanges get set up in the software. The exchanger gets automated. Messages, deadline reminders, etc. So it really takes the manual part of it out of it. From the exchange officers. We still have exchange officers very involved in the process, but the software really provides a very clear way for the exchanger to have visibility to their exchange throughout, which is nice because, as we all know, you have clients who are in the middle of exchanges. It's the most important thing in the world to them, and maybe they don't remember when they have to identify by, or maybe they don't remember exactly what they identified, or they don't know how much money is sitting in their exchange account, or
they're able to get that right away.
You have that right away, and the fact that there's access to that is a really important distinction for the benefits of that software in my mind.
So for broker, the people on our seat and investors. What would you, what do you wish they understood before they, get on the phone and call you? The ins and outs, the nuances of it, or what's?
That's a great question. So I think if I'm talking to a commercial real estate broker, what I always say is very experienced. Most of them are very experienced. They know the rules. They can have the conversations with the client. But it's always great to get a second set of ears or eyes on the transaction, because as much as they've seen and as much as they maybe have a grasp of the deal, it's always nice to say, hey, maybe take a second look at this, or talk to the client. Is there anything you're seeing here, or that you maybe see it's done slightly differently that could benefit the client, or give them a different thought about it?
Okay.
I just think that's an invaluable thing. It's just, makes the client feel like they're being put in touch with a resource. Whether it's applicable or not, or utilized or not, it's really nice for them to feel that way, that they've really had a full set of a full team on that exchange and transaction. So
well, they want to be able to, I always say is just want to show them options, and different options work for different people, but laying out the options for them, be it a 721 UPREIT, a standard 1031, a contract, whatever it may be. Let's look at those. It's much better to look at that ahead of time, as opposed to
right. Hey,
by the way, I'm thinking I'm going to sell, and we want to set this up now.
Right. Hey, we got we have this LLC that owns this property, and a bunch of members, and we all want to do slightly different things. Right. How can we do that? Well, there's ways to do it. Some of them take time. Let's talk about what those are, and let's get that structured the right way, well ahead of time, so it doesn't disrupt the deal as you get close to closing.
So which is kind of leads in, looking ahead, what would you tell an owner who's kind of weighing exchange in the next 12 months? I know one of the big things we keep talking about is look at how you own the property in the entity, and do you have partners? Do you not? Are people going together? Are they not going to go together? The debt situation. Are there other things they should be looking at?
I mean, those are all great things, and I think as sellers, do you want to open the field up and offer seller financing? Is that something that you're interested in? With the interest rates kind of all over the place, do you want to have that conversation with the pool of buyers about doing seller financing, and what does that seller financing then entail for the exchange? It's just those types of things that you're setting the table for, that ultimately you're going to have a more successful exchange. You really can never ask too many questions as part of the process. Where you get in trouble is if you're asking too few, and then you get to closing, and you're in the middle of an exchange, and now you're facing a big tax bill. Nobody wants that. I mean, that's the whole point of talking about this is an option.
Can you do an exchange with a seller contract? Can I take the down payment, so to speak, and do an exchange on that portion? And
so there's a couple different ways in which to look at the seller financing piece. And really, there's 4. So I can just run through those real quickly. Sure. So the first is to do exactly as you said. Take the down payment, run that through the exchange, take the note outside of the exchange. Now, if you're going to take the down payment, do run it through the exchange, there's a couple things to keep in mind. One is, it has to be, since that's the only part that's being exchanged, it's got to be greater than your basis. So let's say, just for easy math, I sell a property for $1 million, $500,000 down, $500,000 carry, and my basis is $200,000. Well, if I put the $500,000 through the exchange, basis is $200,000, I'm going to get a benefit as part of the exchange of $300,000. Right. And the $500,000 note I'll take outside the exchange and pay tax on that as I collect the installment. So that's one option. Okay. The second option is, if you have cash as the seller, you just you become a private money lender, and you loan the buyer the cash. So they give you a promissory note, deed of trust.
So not really, it's part of the deal, but not exactly.
Right. Yeah. Okay. So now you got full amount of cash in the exchange, and then you have a note outside of the exchange that you're collecting on. So that's the other option.
And there's not an issue with related parties or anything like that?
There's not an issue with related parties, because you're simply making a bona fide loan with real interest rates, real terms to the buyer of the property, in order to get the funds into the exchange. The other option is very similar. Let's say you didn't have the cash up front to make that loan, but you could get it over the 180-day period, or maybe the buyer was going to be able to access funds at some point during the 180 days. What you do then is you put the down payment into the exchange, you put the note into the exchange, and then you figure a way out to get cash, to cash that out. Either the seller comes in with their own money, buys the note from the exchange assigns it out to the seller, or the buyer of the note, the seller. So now they have it. So now we have $1 million
sitting in the exchange.
In the exchange, say go buy. Or the buyer says, I don't have it now at closing. I know you want to sell. I can get you the $500 now. In 3 months, I'm going to be able to liquidate my 401k. I'm going to redeem the note, buy the property, and then maybe refinance out later and get my cash back to put it back in my retirement account. So there's definitely ways to do that. The last and most rare way is, let's say $500,000 down, note comes in, and now you or one of your brokers, being the excellent brokers they are, goes and finds a property that they want to buy as replacement property, and you go to the seller of that replacement property and say, Here we have $500,000 down coming from an exchange, and we also have a $500,000 note from the buyer of my property. Are you willing to accept that as consideration for that property? So it all comes through the exchange. It's still valid. So those are
There's
ways,
some options you have.
There's some options in seller financing. Again, it takes time to kind of sort through those. But yeah, and I think that's been, certainly over the last couple of years, a very, common conversation I'm having with people.
Right.
Because of the interest rate, uncertainty.
Yeah, we're just seeing more and more. I think contract sales are coming up more and more.
Right,
so.
Exactly. So
Or at least the discussion about that.
Yeah, it can be done. Again, typically it's going to require the seller to have cash in some way, shape, or form to get the cash into the exchange, unless they're only doing the down payment, which again, they're going to have to make sure with their CPA that, hey, my basis is this. I'm going to get some value from only running the down payment through.
Okay.
So.
Well, thank you for taking the time to sit down and talk to our audience and kind of lighten. If they want to find out more about your firm, they can go to the website down below, and we'll see you next time on Multifamily Market Watch. Thank you.
HFO's entire office specializes in multifamily real estate, making us the largest multifamily brokerage in the Pacific Northwest. Your success is our passion. Like and subscribe to Multifamily Marketwatch videos on YouTube, articles on LinkedIn, and podcasts on all major streaming markets. Build your legacy with HFO. Call 503-241-5541 or visit our website at hfore.com for more information. HFO is a partner of the Global Real Estate Advisor Network.
Love the insights? Tap the like button and click subscribe. It helps us bring more multifamily news straight to you.